Hello. In this chapter, chapter 9, we're going to be discussing a different way to value stocks to see if they're a good buy or not. In the last chapter, we looked at the required return versus the expected return to see if a stock was undervalued or overvalued. In this chapter, we're going to look at the actual price of a stock, what we think the price is going to be compared to what they expect the price to be, to decide whether it's undervalued or overvalued. So we're going to be looking at a few different models to analyze the stock price. We're going to look at the discounted dividend model, the corporate valuation model, and then some other approaches, which is what we call the multiples model. Then we're going to look at preferred stock and see how that's valued at the end of the chapter. All right, so at the beginning of the chapter, for the sake of time, I'm going to let you read this on your own. So just go to the beginning of the chapter and just read about the facts about common stock, ownership, and management's goal. Of course, we talked about this in chapter 1, is to maximize the price of the stock. So you can go over the features of common stock and the facts of common stock on your own. Now, remember from chapter 1, we talked about the intrinsic value of a stock versus the extrinsic value, or the intrinsic value versus the stock price. The extrinsic value is the actual price of the stock right now. That almost never equals the intrinsic value, the true value of the company. In the long run, it will, but as you news or good news, bad news, investor exuberance may cause the price of the stock to go up above where it's truly valued. But remember, in the long run, the intrinsic value should equal the actual stock price. It's a long run equilibrium. But if you can find stocks that are undervalued for the short term, then obviously they're a good buy. All right, these are the models that I talked about that we're going to be going over. So let's look at the discounted dividend model first. Basically, what the discounted dividend model is saying is that P hat sub 0, which is the price of the stock today, should simply equal the present value of the dividend stream. So if you take each of these stocks, okay, and you divide if you take each of these dividends going out to infinity, and you divide it by 1 plus the required rate of return, that's what we went over last chapter, and take the present value of that, find the present value of this stream. Of course, the further you go out theoretically into infinity, it's going to be closer and closer to 0. You'll get the price of the stock. Well, this breaks down. If you have a stock that's growing at a constant rate, where the dividend is growing at a constant rate, this breaks down into a really simple formula, which is this. So here they're just showing you that the dividends, how you would calculate the dividends. So D sub 0, that's the last dividend that was received. That's in the past. So if you want to know what the next dividend is going to be, it's going to be the last dividend times 1 plus the growth rate. And you just multiply 1 plus the growth rate each year to get the current dividend. So they're just saying, what if you wanted to find out today what D sub 2 was, dividend at the end of year 2? You take the last dividend times 1 plus the growth rate squared. All right, so anyway, that's just a little side note there. But this constant growth model tells us that the price of a stock today equals the last dividend that we received times 1 plus the growth rate divided by the required rate of return minus the growth rate. The growth rate's given to us. The required rate of return is either given or you figure it out using the capital asset pricing model. The dividend is given too. So if they give you D sub 0, or if they say the last dividend, that's D sub 0. Sometimes they'll say the next dividend. If it's the next dividend that you expect to receive, that's D sub 1. So here they're just showing how D sub 0 times 1 plus the growth rate equals the next dividend, which is D sub 1. And that's how you calculate what the price of the stock should be today. Here they're just explaining that the growth rate has to be greater than the required rate of return, or else your denominator is negative and it doesn't work. Okay, so here they're calculating the capital asset pricing model to, in order to, hang on one second, I'm going to pause this and come right back. Hey, I'm recording a lecture, but I'm going to come over this afternoon. Okay, bye. Bye. Okay, where was I now? Okay, so this is just showing us again the security market line where you use the capital asset pricing model formula to calculate the required rate of return. And so they've given us beta, market return, risk-free rate, and we see that the required return is 9%. We're going to use that in our dividend growth model. Okay. All right. Here they're just showing you, hang on. Okay, here they're just showing you what the dividends would be if you were going to find the present value of this dividend stream. But just this really doesn't make any sense to even have this here because we're using that constant growth formula. So you don't need to do this. So here's what we need to look at. So they're saying they should have set up here, what is the price of a stock today if the next dividend that we expect to receive is $2.08? The required rate of return is 9% and the growth rate is 4%. So if you come back here, they're telling us that the growth rate is 4% and the last dividend was $2. So if you take $2 times 1.04, you get $2.08. That's the D sub 1. So $2.08 divided by 9%, and you've got to use decimals here, 9% minus 4%, we get the price of the stock is $41.60. So if this were a real world stock, you would go to Yahoo Finance or wherever, look up the price of the stock. If it's trading for under 41.60 based on this, then it's undervalued and it would be a buy. If it's trading over this, then it's overvalued and you would not purchase it. Okay. Here they're just saying if the price of the stock today is 41.60, what should the price of the stock be next year? Well, you just multiply the price of the stock times 1 plus the growth rate. And so right here, I mean, you can do it the long way where you find D sub 2, dividend at the end of year 2 and calculate it, or you can simply take the price of the stock that you just found, multiply it by 1.04, the growth rate, 1 plus the growth rate, and you get the price, what the price should be at the end of year 1, at the end of this year. All right, and then you can skip this. They're just breaking down the capital gains yield and the dividend yield. So if you take the dividend divided by the current price, it gives you the dividend yield. And then you can find the capital gains yield by calculating the change in the price. The price at the end of year 1 minus the current price divided by the current price. So remember, the total return was 9%. Well, from that 9%, you're going to get 5% from the dividend and 4% in capital gains. Okay, now what if a stock didn't have a growth rate at all? What if it was, it's basically a perpetuity? What if it was in a zero growth industry? Well, it still has a value. It's still worth something. So then you would just take the payment, the dividend payment, divided by the required rate of return, and that's the price, what the price of the stock should be. Now, we don't always have the luxury of having a stock that has a constant growth rate. Sometimes stocks will have what's called a supernormal growth or a non-normal growth rate, meaning it's a new company, they have a new product, they're going to be growing at a really rapid rate for the first few years, and then we expect them to go down to a regular constant rate. Or you can have an existing company that has a new product where there's a bunch of demand, so they have a supernormal growth rate for a while, then it goes down to a constant growth rate. So we can't use that constant growth formula when it's not in a constant growth phase. So this is showing us how to calculate the price of a stock that has supernormal growth. So what if a stock had a 30% growth rate for year 1, 20% for year 2, and 10% for year 3, and then has this long run growth rate of 4%? So let's see how we would calculate that. Okay. Now this looks really confusing. It's really not. All we're doing is we have to calculate these dividends by hand when it's in the supernormal growth phase. When it goes constant, then we can find the price of the stock using the constant growth formula, which is what we're doing down here. And then we find the present value of this whole mess here, and that gives us the price of the stock. So let me go through it step by step. The way you set this up is the dividend, the last dividend that was paid was $2. So D sub 0 is $2. The required rate of return is 9%. And the growth rate is going to be 30%, 20%, 10%, and then constant 4%. So it goes constant in year 3. So we need to take this number line out to year 4. First thing we do is calculate the dividends up to year 4. Okay, so we're going to take $2 times 1.3 gives us $2.60. $2 times, well then, the $2.60 times 1.2 gives us $3.12. $3.12 times 1.1 gives us $3.43. And the $3.43 times 1.04 gives us $3.56. That's step 1, calculate these dividends out until it goes constant. Step 2, once it goes constant, then you use the constant growth formula to find the price of the stock. So it goes constant in year 3 here. So the price in year 3, when it goes constant, is going to be D sub 4 divided by the required rate of return minus the growth rate. So so the price in year 3 is going to be $3.56 divided by 0.05, so $71.39. This is called the terminal value. Okay, then we go to step 3. We find the present value of the dividends during the supernormal growth phase and the present value of the price once it went constant. Add those all up, and that's the price of the stock today. Okay, so to find the present value, you're going to use the present value of a lump sum formula. So 260 divided by 1.09 brings it back 1 year. $3.12 divided by 1.09 squared brings it back 2 years. 343 divided by 1.09 cubed brings it back to 265. And then the 7139 divided by 1.09 cubed. This price is in the beginning of year 3. Add those all up, and that's the price of the stock, $62.78. Okay, this slide is just explaining, they're just breaking down the capital gains and the dividend yield again. All right, what if you had a company that was kind of slow to get off the ground and had 0 growth for the first 3 years and then a constant growth rate of 4%? Well, you do the same thing that we just did, only it's a little bit, the calculations are a little bit different. So in this case, the dividend is going to stay at $2 for 3 years. Then it's going to be at 4% growth rate. So $2 times 1.04 is $2.08. Calculate the price when it goes constant. So that's 208 divided by 0.05. We get 41.60. Find the present value. Divide this by $2 divided by 1.09. $2 divided by 1.09 squared. $2 divided by 1.09 cubed, 41.60 divided by 1.09 cubed, add them up, and you see that if it had a 0 growth for the first 3 years and then constant at 4%, the price would be $37.19. So that's how you would calculate that's just another calculation of the non-constant growth. There's the capital gains and the dividend yield. All right, what if a company had negative growth? This company has negative growth of 4%. That still has a value. People would still buy the stock, and you would just have, it can work as long as the denominator rather is still positive. this stock would be valued at $4.17. So you're multiplying this times 1 plus the growth rate, which is 1 plus -4. So it's $2 times 0.96. So D sub 1 is $1.92 divided by 0.13 gives you $14.77. Now, those work fine if a company pays a dividend, but what if a company doesn't pay a dividend? Well, then we can use what's called the corporate valuation model instead of the discounted dividend model. What that means is we're going to take the present value of the cash flows instead of the present value of the dividends to find the price of the stock. So this is just reminding us here from chapter, what was this? Chapter 3, how you calculate the free cash flows. So that would be how you would calculate the free cash flows. And let's see how they're going to work this out. So they've given us these free cash flows here. So this company is supposed to have their weighted average cost of capital this is how much their money is costing them. Their capital is costing them is 7%. Now with this corporate valuation model, it's the whole value of the company. It's not just equity, it's bonds and stocks. So that's why they're saying weighted average cost of capital. So 7% is what their capital is costing them. They have a long run growth of their free cash flows at 5%. That's the constant growth over here. All right, so they think that in the first year they're going to have negative, this is probably millions, negative 5 million in, well, it is million, negative 5 million in cash flows, 10, 20, and then you take, and then it's going to be, you take 20 times 1.05 and you get 21. All right, so usually you go out about 4 or 5 years with these cash flows and you have this terminal cash flow here. So we're going to calculate the terminal value from this last cash flow. And so we get a terminal value of 1,050. So we've got negative 5, 10, 20, and then the terminal value is, or they're calling this in this particular case, horizon value. If it's a corporate valuation model, actually the correct term is the horizon value. Okay, so that's our horizon value. And usually they'll just go out about 4 or 5 years, like I said, and then get this horizon value. All right, so next we're going to find the present value. Divide this by 1.07, 1.07 squared, 1.07 cubed, and divide this by 1.07 cubed. And we're finding the present value of these cash flows, which is 877.5. Okay, now with this corporate valuation model, we have a couple more steps. This 877.5, 877 million, is the value of the firm, the total value of the firm. So in order to find the stock price, we have to subtract the debt out, and then we have to divide that number by the number of shares outstanding. So that's what we're going to do on the next slide. So this company has, we've also got to take out the market value of their non-operating assets. So, or I'm sorry, you add the market value of the non-operating assets. You don't see this too often. The main thing is to take out the market value of the debt and preferred. So here after they do this calculation, they wind up with 842.5 million. That's the market value of the equity. Divide that by the number of shares outstanding, which is 10 million, and we get our stock price of $84.25. So this is just illustrating how you can still use this model. If a company doesn't pay dividends, you just find the present value of the cash flows. And even if a company does pay dividends, you can still do the corporate valuation model, do the discounted dividend model, then the corporate valuation model. And then we can also do these multiples models, which I'm going to show you in a minute, because what most people do, most analysts do, is they'll use all these different valuation models. Then then it gives them a range. And they usually give a range when they'll find the average stock price, but they'll give a range. All right, so because none of this, it's all estimates. None of this, we don't know exactly what the stock price is going to be. Okay, so let's look at the multiples approach. This is really simple. In this case, we are using the multiples of these different ratios. Okay, so let me just refresh your memory. The PE ratio, PE equals the price per share divided by earnings per share. All right, so if you just think about the math here, the PE ratio equals price per share divided by earnings per share. So if you went into Yahoo Finance, for example, you could get the forward PE ratio, what they think the PE ratio is going to be in the future. And then you could look at your current earnings per share. Just look at your net income divided by the number of shares outstanding. Or if you went to Yahoo Finance or any of these websites, it would show you what that was for a stock. So you could look at the forward PE, which they're analyzing the PE ratio in the future, divide that. And so that's going to equal the price per share divided by the earnings per share. We're trying to find the price. So if you take the current earnings per share and multiply that by the PE ratio, the forward PE ratio, it'll give you an estimate of the price. So that's all we're doing with the multiples approach. Earnings per share, current earnings per share times forward PE equals the price. You can do the same with the cash flows. The current cash flows per share times the price to cash flow ratio gives you the price. Same thing here. Current sales per share times the price to sales cash flow, price to sales ratio equals the price. So you see, it's just a little trick with the math. We're just solving for the numerator in these formulas, and that's the multiples model. Okay, then next we have preferred stock. Preferred stock is a hybrid of bonds and common stock. So a preferred stock pays a fixed dividend. Now they can stop the dividend. So remember, with bonds, if a company stops paying interest on the bonds, they're in default. So they almost never do that unless they have serious financial issues. With common stock, a company can stop paying dividends on common stock anytime they want. It's not a good thing because it makes the stock price go down, makes investors unhappy, but they're not obligated to pay a dividend. With the preferred stock, they're not legally obligated to pay a dividend, but it's pretty much guaranteed that you're going to get this set dividend of, say, 8%. So it pays a dividend kind of like bonds pay interest. But here's the deal. If a company stops paying on a preferred stock, they cannot pay any common dividends until they start paying a preferred dividend again. So, you can pretty much count on getting this preferred dividend annually. So it's a fixed dividend. So it's a little less risky than buying common stock. Okay, how do we calculate the value of preferred, or the required return on preferred? Well, the value of a preferred stock, or the price of a preferred stock, is simply the dividend that it's paying divided by the required return. And so here we have the required return is simply the dividend divided by the price. And so they're kind of showing you two formulas here. The required return would be 5%. If you had the price and if you had the required return, you're trying to find the price, you simply take the dividend divided by the required return, 5 divided by 5%, you get $100. That's the price. That's the fair value of this preferred stock. Okay, so in this chapter, just to recap, we're looking at we're calculating the price of a stock to see if it's undervalued or overvalued. So we can look at what the price should be and then look at what it's actually selling for to see if the stock is too expensive right now, overvalued, or it's cheaper, undervalued. All right, so we looked at the dividend, the constant growth model, the dividend discounted model with constant growth, with supernormal growth, Then we looked at the corporate valuation model, if a company doesn't pay a dividend, or if we just want to do that anyway and calculate the present value of the cash flows. And then here we're looking at the value of preferred stock. All right, so that's it for this chapter. And until next time, goodbye for now.